Now, without further delay, let's begin today's event, sponsored by Freddie Mac and hosted by National Mortgage News. I'd like to introduce today's moderator, Mike Perkowski. Mike, you have the floor.
Thank you very much. Ladies and gentlemen, welcome to today's web seminar. We're glad you could take some time out of your busy day to learn more about this topic, build future business opportunities with borrower insights. Before we get any further, I do want to take a moment to again acknowledge and thank Freddie Mac for sponsoring today's program. We appreciate their support. Let me give you a little bit of insight into what we're going to be covering today. We're going to be talking first about some key trends in housing and demographics. We're also going to talk about some of the factors that are impacting home ownership, as well as consumer home buying barriers and needs. And lastly, we'll talk about solutions and tools to serve future clients. Fortunately, to cover this ground today, we have somebody who has extensive knowledge and experience in this field, and that's Jana Davidovich. Jana is the Director of Market Research and Insights for Single Family Marketing and Communications Division at Freddie Mac. She's responsible for market and consumer research, housing insights, and strategic analysis, and she has more than 14 years experience in the residential mortgage and housing industry, spanning the origination, new construction, and secondary market sectors. Before joining Freddie Mac, she was a manager of market intelligence and analytics at Pulte Group and a manager of economics and strategic research at Fannie Mae. We're very fortunate to have Jana with us today, so let's get started. I'm going to turn the program over to our featured presenter, Jana Davidovich. Jana, the floor is now yours.
Thanks, Mike. For this great introduction. Hello, everyone. I am very excited to be here today and be presenting at this amazing data and insights-packed event. At Freddie Mac, we are closely monitoring housing market trends and the drivers impacting national housing supply and demand. But our research goes beyond just macroeconomic and housing trends. We also focus on mortgage industry-related shifts, such as technology or lender operational capabilities. And of course, among other things, we are closely monitoring demographic and consumer trends. And in this next hour, I will be sharing with you some of the key insights that we believe can be useful for industry participants when building future customer pipelines and business strategy. So let's get started. I want to begin with a closer look at the fundamentals driving some of the latest consumer trends. If you found economics projections of single-family mortgage origination activity, you might recall seeing a chart similar to the one in front of you. The chart is a snapshot of a Freddie Mac Chief Economist Office annual single-family mortgage originations in trillions of dollars, where the blue sections of the bar represents the refinance originations and the green parts of the bar being purchase originations. As you can see, the annual mortgage origination levels seen in the past decades are definitely much lower than the ones we have seen in the past couple of years, 2020 and 2021. The elevated origination volume, all or most of it, is driven by record low interest rates, which in turn drive heightened refinance activity. But what I want to bring your attention to in this slide is the gradual ramp up of the purchase origination, the green parts of the bar, which is vividly seen across not just historical years, but the forecasted years as well. And if you are wondering what's driving forecasted increase in purchase origination activity, the answer is favorable demographics. The large cohort of young adults slowly coming into the housing market, and I am sure many of you are seeing this in your pipelines already. So to better prepare ourselves for tomorrow's market, we across the housing ecosystem need to better understand some of the demographic and socioeconomic shifts that are all already and will continue to impact the shape of the national home buying activity trend, including young adults postponing homeownership, increasing age and diversity of the U.S. population. Then we have the essentially the diversity impact in the type of housing that we're going to be looking at. And let's not forget the gig economy construct that will continue to redefine and shape the U.S. labor market. All these factors we will touch on in this discussion later on, and maybe we'll cover it even in more detail. It looks like we have a first polling question, Mike.
Okay, Yana, very good. Well, ladies and gentlemen, this is our first of 4 polling questions. If you would please just take a minute and just let us know your answer to the following. What do you think is the largest adult demographic in the United States today? Which one? Is it the baby boomer demographic, the millennials, the Gen X, or the Gen Z? Obviously, much has been written and said about all of these different demographics. If you would please let us know, again, which one of these do you think is the largest adult demographic in the United States today? Baby boomers, millennials, Gen X, or Gen Z? All right, we're going to give everybody just a few more seconds to give us your answer to this. Click on the radio button of your choice, hit the submit button, and that will record your vote. And in just a few more seconds, we're going to share the results with you and then continue with the rest of our program. All right, I think we've got a good critical mass of the audience having already voted. Let's see what the results look like. All right, so the largest percentage of you, most of you, in fact, think that the millennials, 65%, represent the single largest adult demographic in the U.S. today, followed by boomers and then Gen X and Gen Z. Yana, what do you think about those results?
The ones who've answered millennials, you are absolutely correct. Yes, millennials. Population born between the years 1981 and 1996 have overtaken the baby boomers back in 2019 and became the largest population cohort at 71.2 million population count. We've calculated that nearly 22% of Americans fall into the millennial generation cohort these days. One interesting fact to note here is that back in 2019, more than half of millennials were still in their 20s. And in fact, if you look at the chart on the right, you can certainly see the group that we call younger millennials. The first 2 bars are larger in numbers than the group we call older millennials, the 2 bars on the right of the chart. What does this mean? Well, it means that large number of millennials are still renting or living with their parents. And for the next decade or so, many of them will becoming either first-time homebuyers or repeat buyers. What a pipeline to think about. And speaking of first-time homebuyers, our own Freddie Mac acquisition data shows that the first-time homebuyer purchases are increasing. The chart in front of you represents monthly Freddie Mac first-time homebuyer loan count trends from period of 2020 to 2021, 2000 to 2021, a span of more than 20 years. The level of first-time homebuyer purchases we've seen this year 2021, is the highest we have observed in the past 2 decades. This certainly further underlines the market purchase origination growth projections expectations that I have noted a few slides back. Looking at the trend line, we can see certainly that the number of first-time home buyers increased more during the COVID-19 pandemic period than in any other time periods before that, which certainly makes sense as many renters who've been postponing home purchasing started to seek the security and stability of homeownership. In my private conversations with certain mortgage industry participants, I heard some expressing a sentiment that the first-time home buyer growth that we are observing these days is somewhat temporary and possibly a result of the pandemic. And my answer is that it is possible that the pandemic is accelerating this trend. But if you look at the fundamentals, everything we're seeing points to longer-term growth in mortgage purchase activity, which in part will be driven by first-time home buyers. And the data in the chart in front of you that shows U.S. Census population projections of the young adults 25 to 44, the primary home buying age population, is certainly yet another supporting factor. As you can see on this chart, the population of 25 to 45-year-olds will continue to grow decades to come. But before we move on, I wanted to note that the data insights we capture and will show through this presentation will interchangeably cover either young adults ages 25 to 44 or 45 years old, or millennials who are also between the age of 25 and 44 now. It all depends on the type of data that we're able to capture and the limitation of the data sources. Now, let's take a look at the actual home buying activity available to us through the Freddie Mac data. We can see that millennial share of prime home purchase loans have gradually increased in the past 10 years. In 2020 and 2021, millennials accounted for more than half of purchase mortgages, 52% to be precise, bought by Freddie Mac. And based on our analysis of external data, our counterparts had seen a similar trend. The tailwind from millennial home buyers is still in early stages. This segment of buyers will continue to grow and have an impact on the home buyer trends. In fact, we have just recently compiled a consumer study focused on home ownership trends, barriers, and educational needs. Leveraging the study, we've compiled a set of characteristics, factors associated with prospective and recent home buyers ages 25 to 44. So if you look at the two charts on this page, the chart you see on the left-hand side shows characteristics of the consumers who intend to purchase a residence in the next 3 years. And the chart on the right shows the consumers who purchased a primary residence in the past 3 years. You probably noticed that we created a consumer breakout across characteristics by race and ethnicity. That is so we could better understand the difference in needs and barriers of these consumers. So let's level everyone. Black bars represent the total set of consumers. Dark blue bars are white consumers. Light blue are Asian Americans. Orange bars stand for Black consumers, Black American consumers, where green bars are Hispanic and Latinx consumers. Let's go over some of the key findings on this slide. So the first category, share of consumers with student loans. We found that the higher share of Black prospective and recent home buyers have student loans than any other race and ethnicity. When it comes to multi-generational households, that's the second section there. According to our survey data, nearly 1 in 4 consumers who purchased a primary residence in the past 3 years live in multi-generational households. Interestingly, when you look at the results of the communities of colors, the non-white results go up to 1 in 3 homeowner households being multi-generational. Something to think about it when thinking about the pipeline, the type of housing, the type of dwelling units these consumers would want to purchase. Now, take a look at the share of consumers with bachelor degrees. You can see that significantly higher ratio of Asian prospective and recent home buyers have college degrees than any other race and ethnicity. Next, let's take a look at a single female category. The share of Black single female homeowner households way above any other race and ethnicity. Once again, when thinking about serving a specific consumer segment, let's start thinking about some of these characteristics. Yet another interesting and significant finding that I do show to practically everyone these days is the parental financial support. If you pay close attention, you can see that 60% of all the recent home buyers in some shape or form relied on parental financial support. Down payment, co-signing, funds for closing, that is a very significant finding, as we will see in the future. You might ask why this information is important. I'd say because we are not only able to see the type of consumers that are now purchasing, from the trends perspective, but also can better understand the difference in needs across consumer segments. I probably can talk about that slide forever. If you give me 20 minutes, I'll talk for 20 minutes about that. But let's move on to our next segment, the factors and barriers that are impacting homeownership trends. Before we discuss the individual factors impacting homeownership rate, let's begin with the overall homeownership level conversation. Similar to other life stages, homeownership rate of millennial generation, a cohort of young adults, many of whom are in their peak home buying age, is trailing behind older generations. It is tracking at 48% as of 2020, which is below the rates of older generation when ages 24 to 39, same age as millennials. It is also below the overall homeownership rate that is tracking at 66%, as seen on the left-hand side chart. But despite the low homeownership rate level, the rate has been on the upward trajectory as this generation continued to mature. It has been especially visible in this past year. If you look at the chart on the left, you can certainly see, and clearly definitely see, the 5% point increase in homeownership rate from 2019 to 2020, that little spike over there. This is the highest ramp up in homeownership rate this generation has seen in a given year. The main driver of this jump has been the COVID-19 pandemic, with factors such as record high savings rate, record low interest rates, higher migration, fear of missing out, and health safety concerns all driving more millennials towards homeownership. While there's no optimal homeownership rate though, as we previously discussed, we do expect a further influx of home buyers of this generation as they get older, advance in their careers, reach certain age milestone, and pay off student debt, of course. While there are many factors impacting homeownership level, the one I want to start with is the historical variation in homeownership rate that exists by race and ethnicity. Millennial generation, Hispanic and Latinx, as well as Black consumer homeownership rates are substantially below those of non-Hispanic whites rates, as you could see on the chart on the right. Taking into consideration this variation in rates by race and ethnicity, add to that the highest share of minorities within millennial generation than older generation, the result is a lower overall millennial homeownership rate. Our research suggests that the young adult population that's stepping into the housing market today will not only be in large numbers, but also will be more diverse than the previous generation. Take a closer look at this chart at the charts on this page. Millennials make up the most racially and ethnically diverse adult generation in U.S. history. In 2019, 45% of Generation Y attributed themselves to minorities. And for those that don't know, Generation Y means millennials. And if you look closely, you can certainly see that generation following them, Gen Z, the youngest generation now, is even more diverse than millennials. Think about how this diversity may impact consumer behavior and needs. Recall what we saw a few slides back, the heightened percent of multi-generational households for communities of color, the growing share of female households. All these trends will be factoring in more and more as U.S. population continue to become more diverse. Yet another factor that is affecting homeownership affordability. Less than a year ago, due to low interest rate, housing affordability was at the levels not seen since 2012, the chart on the right. But as of recent, housing affordability has been on a declining trajectory, all due to historically high house price growth. These days, a year-over-year house price growth is balancing between 18% and 20%. And for some states, as the map on the left indicates, it goes even above 25%, those red spots on the west of the region, in the western region. Because of that, it is becoming more and more challenging for the first-time home buyers to attain homeownership. The speed of home price appreciation that is mainly driven by house supply shortages has been a concern for many across the industry. Nevertheless, We at Freddie Mac Chief Economist Office project that the house price appreciation will moderate in the future. In fact, I believe our recent forecast suggests that we'll see a single-digit appreciation in the following year, 22. Sorry. Another important factor that impacts homeownership is migration. While migration was somewhat of a factor prior to pandemic, it became more of a driving force as a result of many companies either shifting to full remote work mode or adopting more liberal work from home policies. This intensified level of migration started to shift home buying activity. Take a closer look at the map in front of you. Idaho, Carolinas, South and North, Oregon, Arizona, Florida are among the top inbound states, the states with net in-migration, people that are moving in. As you can see, more affordable coastal and southern regions have been gaining residents, and with that, new homeowners, while more expensive and tighter markets have been losing residents. One more factor impacting homeownership that I want to note here today is growing level of single-person households. We all know that it is more difficult to secure a mortgage for a single-income household than for a dual-income household. In fact, take a look at the right-hand side chart. You can clearly see that the single-person household have, on average, much lower homeownership rate, the blue line, than the married households, green and orange line. Those are the more likely to have dual income. With the growth of single-person households observed in the past several decades, it is only natural that we will see an impact on the homeownership level. It would be interesting to see how the trend of single-person household will weather in the next decade or so as more millennials will mature and U.S. population becomes more diverse. This brings us to the next sections of this session, consumer home buying barriers and needs. It looks like we have another polling question, Mike.
Thanks, Yana. So ladies and gentlemen, this is our second polling question. As it pertains obviously to this section, we'd like for you to tell us, what do you believe is the top home ownership barrier for first-time home buyers? Is it qualifying for a mortgage? Is it the down payment? Is it overall affordability? Or is it understanding of the mortgage process? Again, which one of these do you believe is the top homeowning barrier for first-time home buyers? Qualifying for a mortgage, down payment, affordability, or understanding the mortgage process. Okay, as we said last time, we're just going to give you a few more seconds to let everybody have an opportunity to cast their vote. In just a minute or so, we're going to share the results with you, and then we will continue on with the rest of our presentation. All right, looks like we've got a good number of people voting. Let's see what the results look like here. All right, actually it's a pretty even divide, pretty close between down payment at almost 46% and overall affordability at almost 35%. Okay, Yana, does that surprise you, those results?
Not at all, but the audience is correct. The ones who said down payments were right. Down payment is the top home ownership barrier. In fact, based on our recent consumer survey, 67% of renters ages 25 to 44 perceive down payment is the biggest barrier to homeownership. To add to this, many consumers still have a skewed notion of the minimum down payment required to buy a home. One of Freddie Mac's studies revealed that nearly 42% of millennials are under the assumption that they are required to put 20% down payment on a home, or they were really unsure on how much is required. In reality, the median down payment in 2020 was 12% for all homebuyers, according to NAR, and 6% for first-time homebuyers. And according to census data, 47% of millennial first-time homebuyers, nearly half if you think about it, put down between 0 and 5% on the home. This is where we, housing market professionals, can educate consumers on options and products that are available across the industry and help them to become more familiar with down payment assistance programs and different type of mortgage products, as less than a third of consumers today are familiar with either products or programs that are available in the market. Yet another homeownership barrier identified by consumers is qualifying for a mortgage. According to a survey, 48% of potential first-time homebuyers, again, ages 25 to 45, cite ability to qualify for a mortgage as a barrier to homeownership. The top impediments when qualifying include high debt, unhealthy credit, low level of affordable housing inventory, and growing home prices. Another important consideration when mining homeownership is financial literacy. A recent study revealed that 47% of potential first-time homebuyers perceive lack of knowledge regarding the home buying process as a barrier. Within the study, we were able to conduct a short financial proficiency test, 3 questions. And the results reveal that only half of consumers today are financially proficient and understand concepts related to interest rate, inflation, or compound interests. Furthermore, we also learned that Black Americans and Hispanic Latinx consumer segments are, on average, less financially proficient than Asian and White American consumers. That's the chart on the right. Moreover, despite the fact that high share of young adults, particularly millennials, have college degrees and have a better handle on digital resources than any older cohorts, they're less financially proficient than older generations. According to a 2018 study by TIAA Institute, fintech usage, such as mobile apps, for instance, when coupled with financial illiteracy, creates a greater tendency for poor money management, suggesting that the usage of fintech tools is not a substitute for financial education, but a complement. But we look for ways to expand homeownership opportunities to a larger share of consumers. Improvement in home buyer education is certainly imperative. Another highly discussed topic I wanted to cover in this section is gig economy. Since 2010, there has been a steady rise in the number of people participating in the gig economy or the non-salaried labor force. We define the sector as being made up of people who earn primary or supplemental income from freelance or other independent work arrangements, such as, say, Uber, DoorDash, something of that sort. McKinsey Global Institute estimates that the total number participating in the gig economy as of 2019 was 68 million people. This is a notable increase from 2011 reports of only 16 million. Experts estimate their number will only accelerate further in the future. Also, an MBO report estimates that millennials make up 38% of the gig economy workers, compared to only 29% of Gen Xers and about 33% of baby boomers. Without a doubt, recent COVID-19 development had put a damper into certain gig economy sectors. However, as the economy starts to recover, the continued growth of the gig economy is certainly inevitable. Many of us across the industry want to better understand how we can help gig economy workers, especially those with irregular income streams, achieve a goal of homeownership. Though the industry is yet to come up with any solid solutions, we are continuing to evaluate options that may help to ease the qualifying process. Sure. One other interesting trend that we are seeing in the market, and I believe is worth noting. And that is that the two largest generational cohorts are now competing for the similar valued properties, which is in this current environment of bidding wars is yet another deterrent for the first-time homebuyers who have very little equity to play with to win the bid. There are several hypotheses that might explain the recent trend of millennials and baby boomers going after similar price properties. First, limited starter home inventory, right? We know that to be the case. It could be causing millennials to rent longer, so when they buy their first home, they skip a starter home and buy larger, more expensive first homes. And also, don't forget, baby boomers are starting to downsize. They are aging, some of them aging in place. Many do downsize and look for smaller properties and are buying smaller homes. Like older generation, young adults see homeownership as their primary financial goals these days. That's the sentiment that we've been receiving, no matter how many surveys we push out there, with the top motivators being wealth creation and a stable place to live and create family memories. But as you had a chance to see in prior slide, the path to homeownership is covered with many challenges. On top of the ones that we just covered, last stage events such as delayed marriage, more years spent obtaining education, higher student debt, having children later in life, further pushes back homeownership for young adults. And where there are barriers and challenges, there might be solutions. Let's next discuss potential solutions and tools for some of the major barriers we just covered. Let's start with changing demographics. As I have mentioned previously, along with the high population number, young adults bring a higher than average degree of racial and ethnic diversity to the U.S. population. The high share of minorities is likely to lead a reduced homeownership rate for this cohort. How can we, in the industry, help to reduce the homeownership gap? Let's start with what Freddie is doing. Broadening educational resources, both in content and language availability, establishing new programs to address financial capabilities and mortgage solutions for communities of color. We also develop plans to further expand partnership with organizations that lead the way to bring greater equality in housing. Moreover, Freddie Mac just submitted a 3-year equitable housing finance plan to a regulator, FHFA, that described our planned effort to advance equity in housing finance. I also want to highlight a few options that the industry can do, which I forgot, and that is would be increasing outreach, providing more targeted and effective financial education programs, as well as increasing awareness and better customized down payment programs options. Moving on to down payment. Yet another challenge that we discussed previously is, of course, down payment savings. The housing industry needs to find ways to encourage savings and make sure young adults understand all the down payment options available to them. To solve for that, Freddie Mac is offering low down payment programs such as Freddie Mac Home Possible Mortgage and the Freddie Mac Home One, and also promoting down payment assistance programs to real estate professionals and other partners. Beyond Freddie, I highlighted potential industry options such as development of digital wallet tools, as well as down payment savings account with a special interest rate and or to match deposits to a certain amount. Also, lenders need to better understand potential borrowers and educate them about the ways to source down payment assistance aside from savings and increase awareness of and better customized down payment assistance programs. One other challenge we discussed earlier is low financial literacy, of course, which is more common with young adults, particularly millennials, even though more online resources are available. Creative partnerships across the housing ecosystem is imperative to improve financial literacy for young adults. What is Freddie doing to address the issue? We offer educational resources such as newly updated Freddie Mac Credit Smart in multiple languages to educate homeowners and help housing professionals guide consumers. Freddie Mac is also partnering across the housing ecosystem to help connect borrowers with valuable resources like our borrower help centers and housing counselors. There are also a few potential industry options to explore, such as creation of effective financial education apps aimed at tech-savvy millennials, increased outreach of housing professionals through class offering high school, colleges, and places of work. Lenders and real estate agents should continue connecting borrowers with housing counselors who can provide guidance and serve as trusted resources. And overall, we are looking for feedback too. While we are trying to move forward in this particular space, if any of you on the call today have any other solutions that you want us to consider, please do reach out. This is extremely important. And speaking of financial education and preferred methods of learning, our recent survey study revealed that the top preferred methods for consumers to learn about homeownership are self-guided online training programs and one-on-one counseling sessions, while live and recorded webinars, we are one of those, are the least favorable method to learn about homeownership for most consumers. When we think of educational solutions, it would be valuable to incorporate these consumer preferences into your strategy. And here we have yet another polling question. I believe this is our last one. Mike, take it away.
Thank you, Yana. Yes, this is our third and final polling question. Once again, we'd like you to give us your answer to the following. What is the number one source that renters leverage to learn about the home buying process? The number one source. Is it their realtor? Is it social media? Is it parents and family? Or is it real estate related websites? Again, which of these choices is the number one source that renters leverage to learn about the home buying process? Realtor, social media, parents and family, or real estate related websites? All right, by now you all know the drill. We're going to wait a few seconds till everybody has a chance to cast their vote. And then we'll share the results again, and we'll continue with the remainder of our presentation. I do want to remind everyone that you do have the opportunity as well to submit questions for the Q&A part of our program. We'd love for you to submit if you are so inclined. All right, let's get started. Let's see what the results look like for this question. All right, interesting. Number one source that renters leverage to learn about the home buying process, social media, more than 50%, followed fairly far down there by parents and family. So Yana, again, does that surprise you, or is that consistent?
It's a bit surprising. So the number one choice for renters to learn about homeowners is actually parents and family. But social media is not far behind. You would be interested to know that the type of tools that consumers use to learn about homeownership process can and do vary significantly based on the homeownership status, whether you are owner or renter. Your preferences do differ. And while realtors and real estate websites defined as a major source to learn about homeownership, young adult renters consider family as their number one resource. This should not be surprising to you guys, though. If you if you recall the slide where we looked at the parental support that is provided to young adults when they're purchasing home, it certainly makes sense, right? You tend to rely on the advice as well as financial support. I wanted to underline again that these consumer preferences extracted out of our survey might help to source your client pipeline and create more personalized customer experience. But I want to go back to one more point, the social media. Social media does play a significant role in renters' view on educational resources related to homeownership. We will spend a minute talking about this in a few slides, but it looks like 34% of renters use social media as one of the sources to learn about homeownership. Okay, let's move on to gig economy. A bit of a change of topic. As we discussed previously, young adults, that's essentially one of the barriers that we've established before. Young adults embrace the gig economy, and as a result, in the future, we may see shifting dynamics of the labor market. In response to this shift, industry and policy changes are definitely necessary to simplify and streamline access to credit mortgage origination process for non-payroll workers. What are we currently doing at Freddie? Offering lender solution for self-employed applicants that save on underwriting times, such as product advisor, asset and income modeler, in short, AIM. Potential industry options to explore here, expanded view of acceptable income stream, as well as creation of new innovative mortgage products. Next on the list, affordable housing shortages. Affordable housing shortages. And when looking at the affordable housing shortages, you know that the shortage of affordable housing has hurt millennials more than any other segment of the home buyers. What can we do? At Freddie Mac, we offer loan options that promote renovation and energy efficiency improvement, like Green Choice and Choice Home mortgages, as well as the Choice Renovation Financing. Freddie Mac offers manufactured housing as well. Housing construction, so potential industry options to explore would be accelerate housing construction and offering more affordable options to meet the demand. To make some of this happen, local governments should consider, and some already are doing this. In fact, recently California just made an announcement about removal of the zoning laws, relaxing excessive regulation and restrictive zoning policy. And let's not forget innovation of housing solution to create and preserve affordable housing through vacant property conversions, educating developers on affordable housing opportunities, shared equity models, and financing of new housing choices. And when we are talking about consumer solutions, we do talk about the consumer segment, sort of in the consumers involved. It is important to understand that the needs, challenges, and opportunities of specific consumer segment in the marketplace do vary significantly. In our research, we found when focusing on a targeted specific consumer segment, we must understand their unique needs and challenges so to serve them better. As this market becomes more diverse and competition intensifies, a personalized approach can create better customer experience and, of course, stickiness. Especially if you know where to find your consumers and which media channels they are using. Going back to the slide that we've discussed previously, the social media. As you can see in this chart, consumers prefer media channel preferences for media channel usage do vary by age and do significantly vary by age. But all of the consumers tend to leverage YouTube to learn about homeownership. Younger generation give more preference to such channels as Snapchat, Instagram, and TikTok. Keep that in mind when creating marketing strategies for your prospective buyers and consumers. This brings us to the last part of the solution sections, buyer personas. I talked about growing diversity of the marketplace and intensified competition. Buyer personas can give you the power to deliver a level of personalized content and service to your prospective clients that a simple customer segmentation approach can never achieve. For example, imagine that your team recent focus has been on an expansion of first-time homebuyer segment. But as you all know, not all first-time homebuyers are created equal. In one case, there's a young couple who is looking to start a family and gain more space. In another, there's a single female who is in favorable financial situation and is looking to buy a property in order to start building equity. The motivation behind the desire to own a home between these two personas are definitely different. Hence, the messaging and description you would use to attract the attention of these two buyer personas are going to be different as well. Let's take a look at the Andres, the consumer persona examples that we've included on this slide. Andres is a part of the fast-growing consumer segment of Hispanic buyers. He's a family man with 2 children. He has an associate degree and just received a promotion. Him and his wife have been thinking about purchasing a home for several years now. They're looking for a home that can accommodate not just the 4 of them, but also Andres' mom. Down payment is the biggest barrier for Andres. He would like to learn more about how to shop for a good mortgage rate, maintain financial health, and of course qualify for a mortgage. He tends to consult with his family and community members on such subjects as home buying process. Andres can benefit from learning more about down payment options and down payment assistance program. You can find Andres on platforms such as YouTube and Facebook. I hope you can see how all these different aspects allow us across the housing ecosystem to make Andres' journey to homeownership more personable and less challenging. Well, in today's market, consumers have grown wary of the bland, one-size-fits-all marketing approaches. They expect to be engaged on a more personal level. In fact, speaking of a personal level, I just saw an article today from National Mortgage News saying that according to GT Powers, it looks like Guild Mortgage is now a number 1 lender in terms of customer satisfaction, actually overpowered the Quicken. And I think the comment there was the personalized approach. We'll use personalized approach. So that speaks clearly to customer satisfaction and personalized approach. And while creating a different marketing strategy for each of your key buyer persona is more work than simply shotgunning a generic message out there in the world, you'll find that it is also much more effective at creating stronger business relationships as you are solving for their needs and creating greater opportunities. That ends the main part of this session. I think we are ready to move on to Q&A.
Jana, thank you very much for not only a lot of great data, but more importantly, a lot of great insight. So let's continue that, and let's address some of the questions that our audience members have for you. And just a reminder for the audience, if time does not allow us to get to all of your questions, someone from Freddie Mac will get back to you after this program. All right, Jana, let's get to our first question. All right, and this is pertinent to something that you just covered. They want to know, what is the difference between consumer segment and buyer persona?
Yeah, that's a great question. It's a good question. Even market researchers with years under their belt can get confused on the difference between these 2 terms. The simple answer is to think of consumer segments as high-level categorical classification of group of people, while personas can represent specific details that speak to a type of person, their experiences, goals, or motivations. Consumer segment help to size and forecast market shifts. In our case, a good example of a segment can be a millennial consumer segment, or Latinx consumer segment is one they'll talk about quite a bit. While persona help to understand the emotional and behavioral triggers behind the individual customers within that market segment. But what's important is that when used together, consumer segment and buyer personas can act as a powerful complementary set of tools for more in-depth and accurate customer targeting and higher customer satisfaction.
Great, thank you, Jana. Let's go to our next question. Our audience member would like to know, do you see younger adults, especially from historically underserved communities, being impacted more or less by COVID-19 than older generations?
Yeah, that's a good question. I believe the answer is depends. It depends on their age, educational level, where they're in their careers, and of course, the industry they're serving in. We have seen pandemic hitting the hardest leisure and hospitality sectors, where technology sectors had actually grew and became more profitable. And because of the proportionally younger adults and minority tend to represent a younger share of employed in a sector such as leisure and hospitality, they were hit the hardest. At the same time, we saw booming housing, as I said, and IT sectors, where compensation growth was beyond anything we have seen before the pandemic. In overall, housing data suggests that young adults experiencing the higher year-over-year jump in homeownership during the COVID-19 pandemic. Because of that, because of the high savings rate, record low interest rates, health safety concerns, which I mentioned previously, that's also to push many young adults towards homeownership. So I think, that there's a bit of a split depending on where you are in terms of your educational level and, of course, the industry you work.
Okay, very good. Let's go on to our next question. So during the discussion, you mentioned that diversity is driving home ownership trends. How can the housing industry better service and support customers' needs, especially those from underserved communities, in realizing their dream of home ownership?
Yeah, certainly. We often talk about millennials as a homogeneous group, spent 15 years of age, and different, they definitely have different ages. We found that, further consumer segmentation is certainly necessary to sort of address those needs and to personalize messaging, as I said.
Very good. Let's go to our next question. Throughout the presentation, you highlighted low financial literacy as one of the key barriers to home ownership. How can we as lenders help to move the needle and help improve the situation?
Yeah, that's a good question. Yes, low financial capability level is certainly a major concern and is more common with younger adults, even though more online resources are available. And I did talk a lot about that. It is our belief that increasing partnership across the housing industry ecosystem to strengthen the financial literacy of these young adults is imperative. There are many things that we could do, could be done. Among them are the creation of effective financial education apps aimed at tech-savvy millennials I've mentioned before. Of course, increased outreach of housing professionals through class offerings. I did talk a little bit about that as well. And creating effective resources as well. Like we actually, through our study, we found that, I've mentioned this, that young adults, despite their education level, do have low financial literacy levels. And that sort of speaks to the quality of the courses or the quality of the education that is received. Also, continue connecting borrowers with housing counselors who can provide guidance and serve as trusted advisors is definitely a good choice. When it comes to actionable insights, leveraging by persona, again, I know I talked about it a lot, we saw that certainly a certain persona have preference for specific methods of learning and have less of a preference for other methods of learning. We can leverage this information and maybe push some of that through the media channels and resources they use and try to reach them through those resources. Also, we at Freddie Mac addressing this issue by offering educational resources such as Freddie Mac Credit Smart in multiple languages to educate homeowners and help housing professionals guide consumers. We're also partnering across the housing ecosystem to help connect borrowers with valuable resources, as I said before, borrower help centers and housing counselors. I did mention some of that as well.
Great. We've got time for one more question. So to use that last question, I want to go to one that's an issue that I think is extremely important and perhaps maybe underappreciated. And so I really want to give this a little bit of airtime, and that's the issue of student loan debt. So our audience member asks, student loan debt is a large hindrance to millennials purchasing a home. Is there a way to solve that?
It takes a village, right? That's what they say. Well, interestingly enough, it's certainly an issue. It's certainly postponing the homeownership. But what we found is that it's not really relaying that. I mean, if you think about it, investment in education is sort of an intangible investment that many of us make, and it pays off. We found that consumers with higher education have a high trajectory, income trajectory, right? So essentially, there are more possibilities for those who attain a higher degree to obtain homeownership than the ones with just the high school degree. But going back to the solving component, I believe, if I don't mean to overstate this, but I do believe that the average consumer debt of a millennial is about $33,000, which is not really, and that's, once again, it's an average, right? There are definitely cases where we've seen certain consumers having over $200,000 in terms of student debt, but it is manageable if you've completed your degree and if if you completed your degree and if you have an earning potential that I've discussed before. But in overall, I think there are definitely solutions that we are looking into. I know there were some talks about debt forgiveness. I don't think it's going to be happening, but there's certainly something that we are looking into.
Yana, very good. Thank you so much for your presentation and for answering questions from the audience today. Ladies and gentlemen, that does conclude our program. We want to take a moment to again thank Yana Davidovich for her presentation and for sharing her insight with us all today. Again, I want to acknowledge and thank Freddie Mac for sponsoring today's program. We appreciate their support. And last but not least, we want to thank all of you who attended today's program. We're glad you could spend some time with us. And we hope that you'll join us for a future web seminar brought to you by National Mortgage News and its partners. Well, on behalf of your host, the sponsor, and your presenter, thank you for joining us, ladies and gentlemen. We hope you have a great and safe day.